Welcome to Growth Investing Mastery. This video will look at reflections on 2022 for growth investors. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to look at the year 2022, which is a year that strikes terror in the heart of growth investors. Many growth investors lost 70% or more simply being fully invested. Growth investors got blindsided by the downturn in growth stocks. And it took myself over a year to come to terms and understand what happened there. In this video, we'll examine what went wrong and some key takeaways and learnings. And this is meant to be a no-holds-barred conversation, so any feedback is welcome, and feel free to challenge anything here. If you're new to Growth Investing Mastery, this channel is focused on getting superior returns. And since we've been tracking our results, we're up 80% year to date and 343% since the start of 2024. Let's first take a look at why 2022 was so challenging. In a short period of time, many software as a service stocks, or SaaS stocks, dropped by 70% or more. And it seemed like every time the interest rate rose, the SaaS stocks would drop by 5 to 10%. On the business side, additional scrutiny came from CTOs and CFOs regarding SaaS pricing, and they were wondering, why are we paying so much for SaaS products? Hardest hit by this downturn in growth stocks and SaaS were experienced growth investors, and that may seem like a bit of a contradiction at first. Shouldn't more experienced investors be better equipped to handle a big downturn like this? But the issue is many experienced growth investors thought they had a comprehensive strategy that was incapable of losing 70%. Additionally, for experienced growth investors, the money is bigger now, and there might be a sense, I can't afford to lose this. And these experienced growth investors might be managing money for their family or even managing money for other people. And it may be challenging to explain to those people how much of the money is gone now. Additionally, it seems like we might have to go back to the drawing board with our strategy. And the real challenge in 2022 was to figure out what parts of our strategy still work. And here were some open questions I had. Which part of our strategy has flaws? Was it because we were not diversified? Is being in just growth stocks too risky? And how is dropping 70% a viable strategy? One big question that kept coming up for me was, why was I all in on SaaS? Stepping back, I realized I'd done this before with an internet mutual fund in 2001, where I was all in and I lost huge. And I was left wondering, did I just repeat the same mistake from 20 years ago? Why was I all in on the hottest sector in the market and I didn't understand the risk? Eventually, I came to a very surprising conclusion. It was understandable I was all in on SaaS. I want to introduce an analogy that we will use throughout the video. And a lot of our best ideas come from great thinkers in the field who came before us. Mark Douglas said, the market is like a river constantly flowing. And Saul mentioned the parable that it's better to learn to fish than to be given a fish. And building off that analogy, we found a spot in the river that always had the biggest fish. Because of that, we kept going back to that spot in the river year after year. And in the early rounds, we found companies such as Shopify, MongoDB, and ServiceNow. These companies went public with low market caps, and companies like Shopify 20x'd in a couple years. Additionally, there were even later rounds of SaaS stocks going public at low valuations. There was Cloudflare going public at a valuation of $5 billion, and CrowdStrike went public as well. But in 2022, there was an earthquake, and the river changed direction. Our old fishing spot is completely dried up, but we keep going back there by habit. Additionally, our skills for finding new fishing spots have atrophied. Let's talk about diversification now. And one key takeaway was that I violated the diversification rule. I had a misconception. I thought because our SaaS companies served a wide variety of verticals, that these SaaS businesses were inherently diversified. And here's an example. CrowdStrike is at banks, tech companies, manufacturers, and oil companies, among others. Additionally, CrowdStrike is a global platform, and it's growing with recurring sales. But I failed to realize I was invested in just one business model. I believed in the superiority of SaaS as a business model above all others. Our skill set became narrow as well, simply learning how to analyze a SaaS company. Because of these lessons, I've created a new rule for myself since then. And this new rule is never more than 50% in any one sector or business model. Currently, we believe AI is the biggest industry with tailwinds. We are conscious that AI is the best new fishing spot, yet we do not always fish here. There are big fish in other parts of the river as well. We want to see if another part of the river offers something superior. Fishing in all areas naturally provides diversification in our portfolio, as we'll find companies in a lot of different industries. Let's talk about how 2022 was not like other downturns. In 2001, tech stocks got crushed, but cyclicals less so. And in 2008, everything went down massively, with financials leading the way. 2022 was unique in that only growth stock investors really lost a lot. So we might have heard some other investors say something like, my 401k is getting killed. It's down 15%. And we might be there silently thinking, I'm supposed to be experienced, but I lost 70%. Comparison to indices and other investors killed our confidence. The result was that many investors overcorrected a winning system that needed a few tweaks. In this process, they may be throwing out everything that worked before. And looking back, they may think, I could have bought the FANG or I could have invested in real estate. Some examples of this overcorrection are holding huge cash balances, switching to a hybrid growth value style, or having oversized safety funds. And just to be clear, there's nothing wrong with having a safety fund. We're talking about an oversized and disproportionately sized one. These overcorrections can cause further lack of confidence because the strategy is not well defined. Lastly, many investors built a new strategy based on fear. The more fearful they get, the bigger the move to cash. Let's now discuss if 2022 could have been avoided entirely. But my past experiences with macro style trading have failed miserably. In 2011, I was convinced European banks would fail, and I went heavily to cash. But the EU changed the rules. The EU backstopped everything, and markets kept rising. And I'm just going to use that simple explanation of backstop everything to describe the scenario. I know it's a bit more subtle than that. In 2020, during the height of the pandemic, economic disaster looked impending. I remember thinking to myself, this could be worse than 2008. I moved heavily to cash, but the Fed backstops everything, and markets rose again. But in 2022, we do not see it coming. The Fed saw inflation and strangles the market. The overcorrection comes from the other side this time. One question I was wondering was, how can we predict when a government official will make an arbitrary choice? And I've noted here, when things seem bleakest, governments tend to overcorrect, like in 2008 with TARP, or in 2011 in the EU, and in 2020 with lowering interest rates in the US. One conclusion we have is our strategy cannot be based on guessing the whims of an official. One additional major strategy flaw I had was I had no strategy for when to get back in after selling in 2011 or 2020. I was waiting for a big correction, but it never came. And my confidence kept going down as I saw markets rise higher and higher. Let's now talk about the SaaS tailwind, which existed from 2010 to 2021. A new business model was vastly underappreciated by the market. Traditional financial metrics to measure these new businesses did not work well. And many looked at SaaS, such as Warren Buffett, and said sales and marketing expenses are over 100% of revenue. Some looked at SaaS and said they aren't profitable, and stock based comp is huge. On the other side, many who were bullish on SaaS failed to recognize we were in a booming business cycle. And one key point is the next bull market leaders will have different business models that do not fit in the traditional models, just like SaaS did. So we see a lot of hardware companies scaling up right now, and they have negative free cash flow, lower margins, big depreciation, and they're using debt and dilution. A lot of growth investors will look at that and think the business doesn't make sense. And some growth investors will miss the next biggest opportunities because it does not fit their paradigm. One key point is we want to invest behind industry tailwinds. Looking back over the past century, here are some of the bigger industry tailwinds. In the 1920s, railroads were booming, and in the 1960s, semiconductors were booming. The 1990s saw semiconductors and internet do well. The 2000s had casual dining, the 2010s, SaaS, and the 2020s, semiconductors. And I threw in a bit of a curveball there with casual dining in the 2000s. Sometimes the industry trends are smaller and only last for a few years. For example, Chipotle, Panera, and Buffalo Wild Wings were three of my top holdings in the 2000s. I also included semiconductors in the list 3 times to demonstrate that the same industry can have business cycles occurring decades apart. Let's now talk about valuations of SaaS during the 2022 timeframe. Valuations for SaaS got out of line historically, even for high-tech companies. Since the companies were typically losing money, there was no PE ratio to measure. And valuations for SaaS were only described in terms of sales. Price to sales became way more popular as a metric, and PS ratios went off the charts approaching 2022 for SaaS businesses. And you would hear people saying things like, all the innovation is in software now, hardware is dead. Or another famous one was, software is eating the world. And people were posting prediction models showing discounted cash flows mapping out till 2030. Net retention rates above 100% seemed like an internal money-making machine. So I would see a company like Snowflake, which had a net retention ratio of over 160%. And it seemed like companies would have to spend on Snowflake forever. If you wanted to sound really fancy, you could say companies will spend ad infinitum. One key missed insight was not recognizing we were near the end of a business cycle in SaaS. Most Fortune 500 companies were already saturated on SaaS products by 2022, and their management teams at the Fortune 500 were looking to reduce costs now. Valuations going off the charts and unlimited enthusiasm were warning signs. And there was a secondary missed insight, not realizing a new business cycle in hardware had begun. And it's not really a coincidence that ChatGPT was released at the end of 2022. I mentioned there was an earthquake in the river analogy, and the name of the earthquake was AI. So at the start of 2022, AI as we know it wasn't released yet, but the tectonic plates were moving beneath the surface. And already in 2023, CTOs and CFOs were asking, what's our AI strategy? Not what's our SaaS strategy? And a huge takeaway here is the old market leaders are rarely the new bull market leaders. Let's now take a look at a key question that kept coming up. Should we stay fully invested? For this discussion, we'll look back at a bit of history. And there was a famous survey from the 1900s. Economists were asked to pick the best global stock markets in the coming century. Many picked countries like Japan and Argentina with flourishing economies. Of the stock markets that got picked, less than half even survived to the year 2000. And initially, this would seem to indicate stock market investing is much riskier than we thought. And a lot of times you'll hear people say, but what if the economy gets really bad? I mean, really, really bad. Or what if World War III breaks out? Or what if the entire government structure changes for the worse? And a big takeaway I had from studying these failed markets was the markets ran up to the last day in completely failed governments. I always found this kind of strange that the market was one of the last institutions standing in a failed economy. And the question of why this is came up, and it seems like the answer is that all the market participants have a self interest to keep the market running. In some cases, share prices reached infinity, but the money was worthless or meaningless. Another key takeaway is the point at which all investors are really scared usually ends up being the bottom. And if it really is the case that it's a total collapse of the society, there's not a whole lot we can do. Our strategy to stay fully invested is grounded in three key principles. The first being that markets run to the last day, the second being peak fear elicits overcorrections from the government, and the third is that bear markets are the best markets to invest in. Let's now examine why bear markets are the best to invest in. One obvious reason is valuations have come way down from their peaks. Another less obvious observation is that companies which can grow in bear markets show extraordinary potential. When market conditions improve, these growing companies gain even more business momentum. And swings to the upside often happen fast, and when least expected, it can often happen after government intervention. The data backs this up. In 2002, 2009, and 2023 were some of the best years to start investing. There may seem to be a bit of a paradox here. Shouldn't we just wait for the bear market and time the bottom? The issue is we cannot predict the future, and we might be waiting a long time. One potential mistake is getting fooled by hindsight bias, forgetting how fearful we were at the time. So in 2009, when things were really starting to bottom out, many people were still really fearful. So we might look back and say, why didn't we just invest more in 2009 when everything was down? But we're also forgetting how scary it was at the moment. Another potential mistake is selling into the bear market when valuations are making more sense now. One more important concept is that market panics are infrequent. Over the past 45 years, there are 4 years that growth investors remember for poor results. And these are 1987, 2001, 2008, and 2022. A key takeaway is there's never been a ranged multi-year downturn. So it's not the 2008 to 2012 bear market or the 2001 to 2004 bear market. And keep in mind, many good years like 2020 or 2025 had scary drops. As we mentioned, the years after typically show strong results in 2002, 2009, or 2023. The data shows us that 4 out of 45 years were considered terrible. But one conclusion is 1 out of 11 years will be really bad for investors on average. The big takeaway is the other 10 years were mostly good for investors, and we do not want to miss the 10 good years, being fearful of one bad year. Let's now talk about why building our edge is important. In 2024, our portfolio surpassed our November 2021 high water mark. Having more edge means we recover faster too. And this can be a potentially hard pill to swallow if we aren't getting results we like right now. We are supposed to be investing money we do not need right away, although sometimes real life events impact that choice. In our portfolio, it took about 2.5 years to recover most of the losses, which were unrealized, and I put unrealized in quotes. I did buy and sell stocks, and I did have tax losses and gains, but the majority stayed fully invested. And smoothing out our graph over a lot of years just continues the upward trajectory. The conclusions are we need to keep building out our skill set to increase our edge. In the fishing analogy, We want to be crafting fishing poles and learning how to fish. We also want to be scouting promising new areas in the river, which means finding rising industries and new business models. We must maintain a beginner mindset. New successful companies won't look like the old ones. A key addition to our strategy after 2022 was a renewed focus on the mental game. Many of us were shell-shocked from 2022, and it was hard to accept how a seemingly comprehensive strategy that was well thought out could have failed like this. A lot of advice on mental game is misguided as it focuses on hardening oneself or renunciation of money. Because of this, we have to borrow from the trading world to find battle-tested strategies that actually work. Short-term traders face similar challenges to growth investors, but with even more pressure. However, the emotions and pitfalls affecting traders and growth investors are similar. We have a study corpus for growth investing mastery on the mental game, and the vast majority of our insights come from these 3 books in one way or another. There's 2 books by Mark Douglas, Trading in the Zone and The Disciplined Trader. And then there's 1 book by Jared Tendler called The Mental Game of Trading, which was really helpful for myself. Focusing on the mental game greatly improved our strategy and our results. Here's a quote from Jared Tendler. Imagine not having greed, fear, tilt, confidence, or discipline problems at all. That's an outcome worth the hard work required to get there. We will now take a look at a new concept I want to introduce, which is called Game Theory Optimal Investing. In the game of poker, a new strategy called Game Theory Optimal, or GTO, took over the game. The computer figured out a way to solve poker so that its strategy was unexploitable. And this GTO strategy did a lot of balanced and simple strategies, but it also did a lot of unconventional strategies. Taking a look at the definition of optimal, I found this online. It's the best possible, most favorable, or most effective for a given situation, outcome, or set of circumstances. It describes something that produces the best results. And there's 2 parts I wanted to highlight here, 2 phrases. The first is the strategy is the most effective, and the second part is it produces the best results. An optimal strategy must be balanced and simple. The balance in our investing strategy comes from no leverage and no hedging. We are exactly in the middle, taking no stance on boosting or anchoring our portfolio. Juicing returns through call options and margin exposes us to the risk of ruin or losing our whole balance. And anchoring with a large cap value stock or hedging prevents us from maximizing returns. Leveraging strategies require paying interest or paying a wide bid-ask spread, and hedging strategies that use cash get eaten up by inflation. And here's our game theory optimal investing, or GTO investing. Staying 100% long and fully invested is both optimal and perfectly balanced. The strategy values simplicity and balance. It also frees up the mind to focus on the individual companies. No cycles are burned reading macro tea leaves or getting bogged down in politics. Because the strategy is optimal and balanced, it never makes sense to deviate in theory. We can sleep well knowing our strategy is balanced. Any of our stocks can 3 to 4x in the near term. Our strategy is backed by sound historical principles, and our edge makes us rise from bear markets quickly. Let's now look at our conclusions for 2022 with growth investors. 2022 was an incredibly challenging year for all growth investors. Our strategy required small tweaks, but not a full overhaul. We diversify more now, not to be all in on any sector or business model. And we continue building our edge, helping us to recover faster from bear markets. We also discovered new mental game strategies that help deal with downturns. These strategies give us battle-tested techniques to dissipate fear and anger. Our strategy stays fully invested and is backed by sound principles and theory. We call this game theory optimal investing, or GTO investing. Years out from 2022, our strategy is improved and refined. We believe our strategy is even more comprehensive now, but we keep looking for ways to improve. This concludes the video on the reflections on 2022. I'm really interested to hear feedback on this commentary, and leave me some comments below for what you think. As the last reminder, this is not investment advice or recommendations to buy stocks. Thank you.